In this video, billionaire investor Leon Cooperman expresses a cautious outlook on the market, particularly due to potential negative repercussions from China's economic challenges affecting Europe. He emphasizes the difficulty in predicting market bottoms and prefers to allow the market to stabilize independently.
I don't want to forecast the bottom. I want to see the market bottom on its own.
Let's talk about some individual stocks, because a lot of the names in your portfolio have been front and center in the news, some of them because of this tariff news. Maybe we start with Apollo. That's been a long-term stock for you, a big holding. It was down 20% on Friday, down 20% last week, and I think down 34% for the year to date. What do you think about the business?
I think they're very well positioned. But again, I'm not adding to it at the current time. My best stock I mentioned in the program last time was Mr. Cooper, which did a very intelligent deal. Very big winner. It's helped me a lot this year. We continue to like it.
What do you think of the Rocket proposal to combine with Cooper in an all-stock deal? I think it's 11 shares of Rocket for 1 share of Mr. Cooper.
We think it's a very intelligent deal. Rocket is the originator of mortgages, and Mr. Cooper does some origination, but they're mainly an MSR holder. So you're creating a real powerhouse of a company, and we think the multiple can rise. And Mr. Cooper, which we're more familiar with Mr. Cooper than the Rocket mortgage. Mr. Cooper management has done an outstanding job. We're very confident in them.
Lee, what happens with mortgages and with the housing picture? Obviously, rates are down, and you could be looking at adjustable rate mortgages, at least, that hit 5.5% soon, just based on what we've seen with some of these things. Is that good news for the market, or is it a lot harder if we head into a downturn, a recession? Is that a lot harder for people then to be able to put up the money for any of this?
No, I mean, housing is typically countercyclical. The problem with it is people have refinanced. This extended period of zero interest rates have led to demand being pulled forward. And so there's not a lot of refinancing to be done. But I suspect that housing will lead us out of this demise in the economy. I have no question about that.
Lee, let's talk about KBR. That's another one of your stocks, and it feeds into defense and supplying there. There have been some concerns about the efforts at DOGE and whether that's going to hurt stocks like KBR. For the 1 year period, it's down 26%. I think it was down 7% on Friday. What's your take?
Well, look, there's never a stock that's down without a reason. There's never a stock that's up without a reason. Okay, and our job is to figure out whether the reasons are reasonable or wrong. And we think that the market is over-discounting the KBR issues. And we don't think the Department of Defense will be cutting back spending anytime soon. Not in the world that we see. We own
Lee,
all the... Well,
I'm sorry. Go ahead.
In the past, in bear markets, he who loses least wins. I expect to give back some of my profits in the last few years, but we're not. We pay taxes. We're not selling, and we're liquid, and we're being very careful.
Okay, so being careful, but still having confidence in the market and not selling out of things.
Yeah, the world's not coming to an end. Interest rates, stocks are very cheap relative to interest rates, and I would say that we've been here before. Recessions last about 6 to 8 months, and bear markets last about the same amount of time, and they go down about 25%. And I read a statistic recently, very rarely has the market persisted to stay below its 200-week moving average for a very long period of time. The 200-week moving average is about 4,600. And a 17 multiple on 250 in earnings is about 4,250. And the way the market is moving, that's not far away.
Lee, you remember the last time we had like a secular bear or like a 10-year period where people didn't make money in the stock market? It's kind of rare, and we haven't, we've been spoiled, I think, since like 1982 or so. Do you think that what's happening right now could get us into a mess like that, where equities do nothing over a decade, or do you think 2 years from now, a year and a half, 2 years, will we be at new highs in the averages, or you just can't make that determination?
I started my Wall Street career on February 1st of 1967. The Dow was 1,000. And 15 years later, 1982 was 1,000. And I made my money picking stocks. I can very well see us in a period of time where price earnings ratios are coming down and the market does nothing. And I would be prepared for that period of time. You know, Warren Buffett makes a comment. When people are very happy when stocks go up, he's not too happy when that happens because he can buy less of it. He rather see stocks go down that he likes, so he can buy more of it. I'm not quite in that camp, but I understand his viewpoint. I do think we're in store for an extended period of lackluster performance in the equity market. I think that what the change out there is real.
Lee, do you think that this is a point, though? I mean, you've said it may not be a bottom. Is it something that could turn around pretty sharply, pretty quickly if the president were to change and ratchet back the tariff policies?
Sure, you can have a short-term rally, but right now I would say a good bottom is not in place. So I would sell strength in the market and only buy weakness. And I'm not really buying much weakness because I don't really trust the environment. There's a lot of things that bother me. You know, I've talked about this in the program. I thought multiples were too high in the market. The other thing I've said is that the debt buildup is very concerning to me. And the president has clearly decided to deal with that debt buildup. And you can't correct 30 years of economic mismanagement overnight. So I think he's doing the right things, but he's moving too fast.